Take a look at this Bitcoin price chart. If you drag it from the early days to the present, you will see a trend line that has gone almost nowhere but up, and it seems like the future will keep moving upward. And when you look at that, it is very easy to think that Bitcoin seems like a great deal for the people who already own it and keep buying more. Now, take a look at a different image. This is Bitcoin being traded at full speed on Binance, one of the biggest crypto exchanges in the world. The trading volume always looks huge. It feels like money is constantly pouring into the market. But hold on, what you are seeing may not be what is actually happening. A lot of that excitement may be an illusion. And the thing behind it is something people constantly praise: USDT. In this video, let us peel back the layers one by one and see what this market is really made of. First, let me ask you something. When you trade crypto, what do you actually use to buy and sell? Do you use US, dollars, Vietnamese dong, or in the end, is it still USDT? The reality is that for most people in crypto, even if you deposit US dollars or any other fiat currency, a huge number of trades still end up going through USDT. You buy Bitcoin with USDT. You sell Bitcoin and get back USDT. You trade altcoins, futures, or margin, and almost everything still revolves around USDT. That is why USDT sits at the center of the crypto market, not the US dollar, or even Bitcoin. At the same time, when people see Bitcoin rising, altcoins pumping, and total market cap jumping by hundreds of billions of dollars, they usually assume one thing: a lot of real money must have just entered the market. But that is not really how crypto works. In crypto, USDT acts like a middle layer between real money and the entire trading system. In practice, the process usually goes like this. You use fiat money, for example US dollars, to buy USDT. Then you use that USDT to trade across the whole crypto system. If every one US dollar created exactly one USDT, then in theory, you could say that money was truly added to the market. But this is where the problem starts. Crypto is not like stocks or real estate, where real money has to flow directly into each asset. Once real money has been exchanged for USDT, that money mostly stops moving, and most of the trading after that is just USDT being swapped around between different tokens. You use USDT to buy Bitcoin. Bitcoin goes up, you sell it, and you get USDT again. Then you use that USDT to buy altcoins, trade futures, or use margin. Every cycle still runs through USDT. So prices can surge and market cap can expand, but that does not mean an equal amount of real money has entered the market. A huge part of crypto growth happens inside the USDT system, not from a non-stop flow of fresh US dollars. And that is where many people get confused. When they see market cap rise by hundreds of billions of dollars, they think that money is all new capital. But in many cases, it is just USDT circulating inside the system and pushing asset prices higher, not new fiat money coming in. That also means the trading volume you and I see does not truly reflect how much real money is involved. The volume looks massive, but a meaningful part of it is just USDT being bought and sold again and again inside the same system. To put it simply, USDT is distorting the reality of the crypto market. It makes the market look more active, more liquid, and stronger than the foundation underneath really is. That does not mean crypto is fake, but it can easily make investors misjudge the level of risk. This may seem like a small detail, but it shows how USDT has been quietly misleading both you and me. But if it stopped there, USDT would only be distorting how we see the market. The more serious problem is somewhere else. The real issue is not just that USDT makes the market look inflated. It is that the entire crypto market runs around USDT. When one thing becomes the trading tool, the pricing unit, and the temporary safe place, it is no longer just a normal token. It becomes the center of the whole system. So what happens if USDT ever collapses? USDT is completely different from a normal altcoin. If one altcoin crashes, the market only loses that one coin. The damage is mostly limited to the money you put into that specific coin, while the rest of the market keeps functioning. But if USDT crashes, the way investors lose money is completely different. First, your money can lose value even if you never touched a trash coin. A lot of investors, maybe you included, may be sitting on the sidelines holding USDT while waiting for an opportunity. But if USDT loses trust and loses value, that USDT may no longer be useful for buying or selling. At that point, your assets are basically gone. Second, if you are trading futures or margin, losses can happen even if Bitcoin does not crash. USDT is the collateral asset. When USDT is no longer seen as trustworthy, the system treats that collateral as invalid. Orders get force closed, positions get liquidated, and you lose money. Third, in DeFi, the damage can be even worse. Positions that use USDT for borrowing can be liquidated immediately because smart contracts do not care about the reason. Once the collateral drops below the safety threshold, the sell-off starts automatically. Your other assets in that position, whether Bitcoin or altcoins, can be sold off to cover the loss. And in liquidity pools that include USDT, once the market turns against USDT, the whole pool can become badly imbalanced. If you pull out liquidity at that point, you will mostly get back USDT, which could be worth very little or even nothing. But the risk of USDT does not stop with that first shock. Over the longer term, once trust in USDT is broken, the entire liquidity structure of the crypto market may have to be rebuilt from scratch. Exchanges would be forced to remove USDT pairs and switch to other stablecoins or fiat currencies, while new money may not come in fast enough to replace it. At that point, the market could be dragged into a long freeze. Trading volume would drop hard. Leverage and margin would tighten. DeFi would not have enough liquidity to work efficiently. Even Bitcoin and other coins with real value behind them would still come under pressure because the market would no longer have a large enough liquidity system to absorb buying and selling. The price might still exist, but the market would become thinner, more volatile, and far riskier for investors. In other words, a USDT shock would not just make investors lose money in the short term. It could also weaken the operating foundation of the entire crypto market for a long time. To sum it up, USDT is the liquidity backbone of the crypto market. It is too important to ignore. And because it is so important, the biggest question now is this: is USDT really safe enough to carry that responsibility? Or does it have risks that could make it collapse? Unfortunately, the answer right now is yes. USDT does carry real risk, and that risk comes from its structure and the amount of power it holds. First, there is one very important thing to understand. USDT is not the US dollar, and it is not central bank money. USDT is a token issued by a private company called Tether Limited, yet it carries more than 70% of all stablecoin liquidity in the crypto market, with a market cap above 180 billion US dollars in 2025. In other words, a market that was supposed to be decentralized is now heavily dependent on a single centralized entity. The next issue is reserve backing. Tether has always claimed that 1 USDT equals 1 US dollar. But based on the latest assurance reports from BDO Italia, the amount of actual cash Tether holds in banks is less than 1%. And that alone is enough to make people uneasy. So what makes up the rest? US. Treasury bills, secured loans, gold, Bitcoin, and even long-term investments that cannot always be sold quickly. That means USDT is backed by assets, but not by assets that can always be turned into cash right away. In normal conditions, that may not be a problem. But if trust breaks all at once, and a large number of people rush to redeem or exit USDT at the same time, this becomes a critical weakness. Even more worrying is the lending side. Tether once promised it would reduce its loans to zero. But by the end of 2025, secured loans had climbed back to more than 14 billion US dollars, while shareholder equity was only around 6 to 7 billion US dollars. That means if the market drops hard and collateral loses value faster than Tether can manage it, the company may not have enough cushion to absorb the shock. And this is not just some far-fetched theory. The lawsuit between Celsius and Tether, tied to the liquidation of nearly 40,000 Bitcoin, is still being allowed to move forward in US court, which shows that the legal risk tied to Tether's lending activity is very real. Finally, there is legal and geopolitical risk. Tether has already been fined by the New York Attorney General and the Commodity Futures Trading Commission for misleading statements about its reserves. And according to reports from the Wall Street Journal, Tether remains under scrutiny from the US Department of Justice over possible money laundering and sanctions evasion. One detail very few people notice is that Tether holds more than 130 billion US dollars in US Treasury bills. That makes USDT too big to ignore, but also extremely sensitive politically. If one day, for legal reasons or national security concerns, those reserves get frozen or seized, USDT could lose value almost instantly, without even needing to formally lose its peg. To sum it up, USDT is not a bomb that is guaranteed to go off, but it is the biggest concentration of risk in the crypto market today. That does not mean you need to panic or walk away from crypto. The truth is, no investment is completely safe. Not stocks, not real estate, not even bank deposits. Crypto is no different. Risk is part of the game, but there is one thing you really need to understand. Do not assume USDT is the same as perfectly safe cash. USDT is only a middle layer tool, not real US dollars. And it is carrying far too many roles across the entire ecosystem. Do not put all your assets into one single point that could fail before you have time to react. When you are staying out of the market and do not need to trade, the safer move is still to cash out into fiat instead of keeping everything in USDT just for convenience. Holding USDT makes trading easier, but it is not a truly safe long-term shelter. And finally, if you want to invest in or trade crypto, stick with reputable exchanges that have strong liquidity, a large user base, and a clear operating history. There are still plenty of scam exchanges and fake apps out there. In the video description, I have already included links to a few trusted exchanges for you to check out. Crypto will always have opportunities, but it really only rewards people who understand what they are holding and where the risks actually are. In the next videos, I will keep breaking these topics down further so you can see this fascinating market with a clearer and more level-headed view.